it's up to you to determine the price at which you sell your property based on your numbers.
And you don't have to sell it. You can even refinance commercial, and they'll use the same math we just went through. So if you, Sebastian, were to buy a building and to improve its profitability by $10,000, we just saw that it's $142,000 in valuation increase, right? So if you did it by $100,000, it's $1.4 million in valuation increase.
That's a lot.
But it scales, and it's linear, and you could go back to your bank and say, hey, listen, I've driven the value of this property up. I'd like to refinance some of that value out and go buy it. So it's all about sort of keeping that capital moving forward, and it's tax-free as opposed to selling it. You pay taxes.
What's up, guys? Welcome to another episode of Invest Iowa. Today, I have Eric with me that is going to walk me through what it's like to be an investor, how to get started in that journey, what the strategies and steps that took him into that journey. And without further ado, please introduce yourself. Happy to have you here.
Thanks so much, Sebastian.
Yeah. So what should we listen to you? Who are you? Where do you come from?
Sure. I'm Eric Fitzgerald. I've been in Des Moines now for 7 years. My wife is originally from the Cedar Rapids area, and I grew up in Denver, Colorado. And we've been doing a lot of investing actually in Des Moines and enjoying it a lot. It's a great market.
Okay. Full-time investor now?
No. Still working. Still doing evenings and weekends.
Gotcha. Where do you currently work?
I work at a children's publishing company. Actually, I'm a vice president of sales. So I work with all our sales reps and customers around the country.
Do you teach people how to sell?
I do.
You do?
Yes, I do.
Okay. Yeah. 5 takeaways.
5 takeaways. Let's see. Trial closes. You have two ears and one mouth. Use them in that proportion, and you'll do fine. Ask questions and listen. What else? 5 takeaways. There's 3.
Okay, let's do 3 for now.
Okay. Yeah. So really enjoy selling and working with our customers. We have great customers, and work with kids, make a difference in kids' lives every day.
Is that in Denver, or is that here in Des Moines?
It's actually based out of Minneapolis. So I telecommute to Minneapolis for 20 years.
Oh, okay.
Yeah.
So. I know a handful of people that do that, and very successful.
Oh, that's great.
Yeah. Okay, so walk me through your first years of getting into the workforce. Did you go to college?
I did not go to college. I was an aircraft mechanic. I worked for Boeing.
Aircraft?
Yes, fixing airplanes.
Oh, wow.
Yeah.
Commercial airplane?
Yep. All the big ones. I did the wide body international flights. So lots of neat stuff. And I worked on the special projects for Boeing. So if they had a new thing they were trying to test, I would work on that team. Taught me a lot of troubleshooting and a lot of teamwork. So it was a very good learning experience.
And how old were you when you were doing that?
20.
20?
Mm-hmm.
Okay.
Yep. So did that for 4 years, and then started working as a sales rep in Colorado with educational materials.
Okay.
And my family has always been in real estate, sort of as investors. My grandfather in San Francisco was a big developer of single-family homes, and then my parents always had rental homes growing up. So kind of worked nights and weekends like I do now, fixing rentals and cleaning things up and doing all the fun stuff you do.
Gotcha.
So
a lot of multifamily, or you stay
all
more
single family.
All single family?
Yeah.
Why single family?
I think cost wise, and then just the accessibility of the mortgages, I think, is a little easier on single family. And then I think when my folks started, there was no Bigger Pockets. There was no, Darsum.
No education.
Sharing things.
No Invest Iowa.
Right. No Invest Iowa. So there was exactly the availability of information about how to do different things wasn't there.
Okay.
And so in this case, my folks and my grandparents before that, that was just the model that they had, and they worked it. So.
Right. So when you're saying that you've become very aligned with real estate throughout your life because your family was involved in it, mm-hmm. right? When do you actually go on your own and start getting interested into mm-hmm. real estate yourself?
I started, had kids young, and So I really focused on my career and didn't really have any extra money or extra time. And I didn't really think of it, I guess. I was sort of living my young life. So I'm always super impressed when there's young people that are planning ahead and working. I mean, I can't imagine how different it would be if I started 5 years or 10 years or 15 years earlier than I did.
So you were a late starter.
I would say probably a late starter, yes.
Yeah. How old were you when you this
I was probably mid 40s, early 40s.
mid 40s?
Yeah.
Oh wow.
Yeah.
Okay, so from 20 to 40 you were on that working,
Yep.
commuting to work and
Yep.
learning how to be a sales rep.
You got it.
All that time being a sales rep?
Yep. Yep. Focused on learning to be a sales rep and then teaching others to be a successful sales rep. Yep.
20 years of experience as a sales rep.
Correct.
And you can't give me 5 takeaways?
I gave you some good ones.
You did give me some good ones. So how is the situation, before we get into what you did after your 40s, how is the situation in Denver and in Iowa?
Yep.
Colorado, Iowa, sorry.
Yep. Colorado has been a very high growth market. It's now the most expensive non-coastal city in the U.S., from what I read. So it's a very expensive market. And that has shifted a lot of the profitability of buying rental properties there. Basically, they're pricing in growth for 2 and 3 years from now in the price. So to make the math work as an income property, you'd have to either put a whole lot down, or you would have to wait for several years to get it developed to the point where the income is greater than the expenses.
Okay, so more of a long-term vision.
Yes. And so great market. Rents have been going up very quickly, but so have prices.
Rents were a problem in Colorado, right?
Oh yeah, cost of living in general is a problem in Colorado.
Why? Is there too many people going there?
Yeah, the growth. Like I said, it's the most expensive non-coastal city in America now.
Okay, because I did watch a video that in order to rent an apartment, you have to have the best offer, right? It's just
Yes.
like a crazy market.
Yeah, it's very crazy. That's starting to wane a little bit. People are moving back out, mostly because of cost of living. But very expensive market. And then on the landlord side, it's the same situation. It's if you've owned property there for a long time, it's great. If you're trying to buy in, it's very difficult to buy in and have the math work.
So how do you compare Iowa and Colorado in terms of real estate? Like what do you see are the main strategies that most investors are managing on each side?
Yeah, so I think Iowa, you can focus on cash flow, and you can buy a property and have it cash flow relatively quickly, usually within the first year. We've yet to buy a property that didn't cash flow immediately in Iowa. In Denver, we're sort of just in a hold pattern, and the way we're doing the buying in Iowa is by refinancing the equity out of properties in Colorado. So as that tremendous appreciation is taking place, we'll scrape the money off,
Put it into
bring
some
it
more
to
save
Iowa,
in Iowa.
and that's right. And so that's been our expansion model thus far. So we've taken money out in the form of a second on our personal home. We've refinanced our rental properties there twice.
Gotcha.
And then that gets us a war chest of cash to bring to Iowa and invest in multifamily is what we've been doing in Iowa.
When you talk about rental properties, are we talking about long-term rental properties or more like Airbnb?
No, all long-term. One of the keys for me, because I do have a full-time job, is I've got to have it relatively simple. I do build a team around each property. So in Colorado, I've got my partner is my brother, and so he's doing all the property management and focusing on that. And then here in Des Moines, each of the multifamilies we purchase, we'll bring in an inside and an outside manager. So I have sort of someone taking care of the outside of the building. Oftentimes they'll also do some handyman work, and then someone doing all the leasing and tenant communications and all the compliance type things.
Gotcha.
So I have some incredible partners in Des Moines that have been just amazing at managing the property. So I am not involved in the day-to-day at all.
What is it curious about those strategies? What do you find that works the best when trying to outsource some of this projects, right? Like, because you can't manage it yourself.
No, I can't. I mean, not and do a good job at my job, which I love and and think is important to what I'm doing. So I definitely want to make sure I'm doing a great job at my job and that these buildings do well. I think one of the strategies is sort of understanding you can tell someone exactly what to do, or you can give them sort of the keys to the bus and say, I need you to get to this destination however you see fit. You really can't do both. So either you can find people that want to be micromanaged and led, or find people that want to be empowered and will go and have a sense of ownership of the building. And I've got some great people that really are very engaged in the buildings.
So the strategy is finding that sweet spot.
Right. And giving them license to do it their way.
Gotcha.
So, I have standards of how I want things to look, but they're very big picture standards. So as an example, I say I want to be the cleanest, safest workforce housing in the neighborhoods I'm in. And so that's a goal I set. I want it to be clean. I want it to be safe. I want the building to be better than its competition, but still affordable.
Okay.
So that's kind of been that's a guiding principle to everything we do, right? Is this helping it stay clean? Is this helping it stay safe? Are we, treating people the right way, but still have it not be a $2,000 a month rent? So
right.
That's kind of, those are driving principles in the buildings, and we all talk about how we're making it clean, safe, but still keeping it affordable.
Now, we're talking about Des Moines Metro or the surrounding.
We do have we have a building in the Des Moines Metro, inner city, and then we have a building in Adel, so a small town.
Okay. What are the differences in those? What are some
big differences? Big differences.
Tell me about it.
I think the small town, you've got there's a lot more communication amongst tenants, and like everybody knows what's going on. Mm-hmm. So you got to be prepared. Whatever you do is going to become kind of an expectation for everything.
Yeah. So we're talking about like maybe raising prices.
Mm-hmm. Raising prices, giving someone, someone's sort of not following the rules, and you give them a break, then pretty soon everybody hears about it, and everybody thinks that's the new standard of how things can happen.
Oh, okay.
Somebody doesn't pay rent, and you let it slide. Pretty soon everybody thinks it's just okay to let it slide.
Right.
So everything is a precedent and gets sort of communicated.
What about in the inner city?
In the inner city, we have primarily immigrants in that building, and they're just fantastically hardworking. They're really easy to work with. They all are very interested in making sure they're doing everything exactly right.
Wow.
So they've been great tenants.
Gotcha. And are these people renting by room or by apartment?
It's all full apartments.
Full apartments.
Yeah. Haven't done anything with Airbnb or breaking it into rooms. Again, primarily because we need to keep it simple for time.
Right. How do you get these tenants?
So we use RentTech. I know there's AppFolio and a bunch of others. I don't know how you would do it more than 5 or 6 units without some piece of software.
Right.
But basically that allows us to syndicate advertising across, 15 or 20 platforms.
Let's bring it back to 40 years old, right? That's when you start to actively invest?
Yeah. I started reading all the books I could and studying Bigger Pockets has been a great resource. They've got a lot of really advanced techniques on there that are way over my head. But certainly their combination of some of the simple principles seems like any of those strategies work. Whether it's Burr or, whatever. And then, of course, house hacking. I wish I would have known about that when I was younger. That's amazing. But one of the cool things about real estate is you can stack strategies. And so, you can do combinations of these things to your own mix.
As in house hacking and then having a single family and then a multi.
Yeah, you can do different parts of all these different strategies in a different combination as appropriate to every situation.
Okay.
Which I find really interesting.
So Was that the way that you developed your strategy? Is that how you went about real estate, or you just went with single
I think
family?
more than anything, it gave me like understanding all the different strategies and having people talk about what they've done. You know, hearing those stories, you can sort of say, "Oh, that's really interesting. I'm going to take that piece." And then every opportunity that we've had since then, we kind of customized our strategy based on that opportunity. You know, every property's got a different situation, and they say when you're buying investment real estate, you're buying someone else's problem.
Right.
And so, like, to understand right away what is the problem I'm buying, and do I have the tools and the ideas to get past that problem for myself.
Gotcha.
So I think it's been really neat to just sort of have an understanding of all the different strategies, their attributes. When would you apply one versus another, and put them together in combination is a really fun kind of thing that I like about real estate.
So what was your first strategy?
Don't lose money.
Don't lose money.
I think the first one was everyone has this goal of I'm going to buy a piece of property and pay it off. And I think getting comfortable with debt and getting control of debt is a critical piece. And just feeling like that's okay. You know, we get told debt is bad, pay everything off.
Yes.
I think that makes perfect sense if you don't have the discipline to use debt responsibly. And I think one big turning point for me was just understanding the goal isn't to pay things off. The goal is to buy more things that'll pay for both. You know, and you can kind of snowball.
Cash flow.
Yeah.
Yeah.
But yeah, I think that's the neat thing about real estate is, in general, if you don't make any serious mistakes, you can kind of learn and grow with actually way more safety than you would think. You know, as long as you're making just even decent decisions, all these strategies work. All these strategies make money. All these strategies are generally going to come out okay in the end. Even bad decisions work out.
So what was your first strategy? What was your first property? Was it single family or?
Yep, single family and in Denver. And the first strategy was really to leverage it and keep that capital moving, not let all that value get stuck in one building.
Mm-hmm.
And so, the choices are you could sell it, that has tax consequences, or if you refinance it, there's no tax consequence. Mm. And so you can take that capital that's just sitting there idly in one property,
down payment for another
and
one,
becomes a down payment for another one. And of course, it'll be interesting with right now today, mortgage rates are double what they were when I last refinanced all my properties, and so that strategy maybe doesn't work as well right now.
Yeah.
So, but and we're to the point where the prices are still high and the cost of money is high, and that doesn't work. So I think a lot of people are sort of on the sidelines waiting for something to break, right? Either prices have to come down or the cost of money have to come down or some combination. So for myself personally, I'm sort of watching the market very closely and just trying to see what's going to break and in what way.
How do you follow the market personally?
I'm on every site, right? LoopNet for commercial, Zillow, Redfin, all of them. I've got searches that are just sitting there, and I'll go through them every night as I'm watching TV and just kind of watch what's happening in the market right now. Not so much that I'm actively buying, more I just want to understand how much is a 3-bedroom, 2-bath in a certain neighborhood going for, and just trying to keep mental notes of where that is sitting.
So in case you take action, then you know where your numbers are at.
Then I can move with confidence.
Mm.
So,
Okay.
If I'm sort of just doing an overview scan all the time, when something hits the market, I instantly can go, oh, that's a good deal.
Do you think it becomes an obsession?
Oh, for sure. Yeah.
Sometimes I find myself watching, just looking at properties at 2 a.m. in
Yeah.
the morning. And
Oh,
still
all the time.
Yeah?
Yeah.
Is that something that also happens to you?
Constantly. Yeah. I look, yeah.
For no reason. You're not going to buy them. You're
No.
just seeing if it's a good deal or not.
Yeah. And learning, just trying to monitor. So, and then we've gotten into commercial in the form of multifamily. And so anything that is 4 units or less is considered residential, 5 units or more is commercial. And that's been very interesting. So the loan structures are different. It's at least it seems as though you kind of have to know people. So I go to meetups and make sure I'm learning, like meeting commercial bankers. I have a fantastic partner now that I've done all my commercial loans with. And, I treat him as if he's a partner in the business. So when I get done doing a quarterly statement and just sort of doing a summary of the financials, I send it to him, and I'm very transparent with him and just say, hey, this is how this building's looking. This is how this one did this month. And the reason I behave that way is he is a partner. He has 75% of the money in that property. I have 25.
Right.
And so the fact that he doesn't have to come ask me, hey, can I get financials for this year? Because he's been seeing them every quarter all along. And he's a great guy. I love catching up with him. But just building that relationship and having that transparency and that trust, I think, is really helpful, because now I can go back when I find a good deal and I've got somebody that trusts me and knows how I run it, and I'm going to run it clean.
You can go together.
And the whole thing is based on us working together as partners, because we literally are partners. Like, people don't think of their banker as their partner. I'm in the same way with the insurance agent and all these folks, is just make sure that I'm keeping up a personal relationship and just being very clear with them what's happening and what my needs are, so when opportunities come, I can move quickly.
That's a big one.
Because they know it's okay to.
They are in the market as well.
They're in the market, and they know my properties inside and out, because I tell them everything I know. So I'm constantly sending little notes. It can be as simple as a text. Hey, we just hit a milestone with this building. We got 100% occupancy, and we've turned 21 units this month, or this year, not this month. But
wow, that'll be a good mark.
Right.
Okay, I did hear you mention that we were looking into some single family, and now you said some of the commercial side. What are your experiences in that transition? I think that most investors, once you start capitalizing, go from residential to commercial.
Yep.
What does that look like?
Well, obviously playing the two markets enabled us to do that in a really unique way, in that we had properties that were just going through the roof on value every year. I could almost refinance and buy a small commercial in Des Moines. So the two markets has been very helpful in that. But what I find interesting about commercial versus residential is how the valuations are driven. And, you can look this up. It's pretty widely known. Well, just totally widely known. But basically, forced appreciation on commercial is way more possible. So of the four ways you can make money on real estate, appreciation is one of them. And in many cases can be the most powerful tool, right? It's not cash in your pocket every month, but it grows your net worth and your value, your financial value. With single family, it's very difficult to get forced appreciation, right? You got to do a flip, or some kind of process where you put a lot of money and a lot of time into a building, and then you can get hopefully a multiple greater than one back of that money. That's the one thing you can do one time. You can't do that every year, where you're putting $10,000 or $20,000 into a single family home to improve it, to add value. So you really only get one big shot at that, right? And then after that, you're completely passive on the process, and you're waiting for the market to go up and drag you with it. With commercial, it gets valued as a business. So anything that is 5 or more, they don't look at here's a 10-unit apartment that's sold and here's one for sale. This value drives how we calculate that value. They don't do that. So on a single family house, they say here's a house, here's one just like it for sale. This one and this one are the same.
Sales comparison.
Right. And they're going to say this one's got a $5,000 better location, and that one had a $2,000 better bathroom, and right, they're going to kind of go through the detail and figure that all out. But mostly it's the neighborhood and that house and the comparables to that house. On commercial, it's really looking at buying it as a business. So you don't think in the same way as I'm buying real estate. You think I'm buying a business. Mm. And so the way you calculate, the simple way, is income minus expenses. And if it's a 7 cap rate, you can say, let's say it's a $200,000 income, $100,000 worth of expenses, so you have $100,000 worth of profit. divide that by 0.07 for a cap rate, and it'll pop up a number, which is the value of that building. If you believe that class of building sells at a cap rate of 7 in Des Moines, there's your value.
Let's take it back one step to the cap rate.
Yep.
For the people that don't necessarily are as familiar with cap rate and how you can better understand how fast you did that math.
Yep.
Okay, let's do it one more time, but now let's
Sure.
explain it.
So the cap rate, capitalization rate, is basically a metric that would be used in the financial world to say if you invest a certain amount of money, here's what you can expect for a return.
Yearly.
Right. Yep. And so that is profitability. It's a simple metric for profitability. It's the same one you'd use if you were running a business or, buying real estate in commercial. And so that capitalization rate, which is frequently shortened to cap rate, it becomes kind of standard, right? So if you're buying a Class A office building in West Des Moines, those are selling at a certain cap rate. If you're buying a Class C apartment building in Adel, Iowa, that's going to sell maybe at a little bit different cap rate. So it's based on the condition, the kind of property, and the location. But basically, any commercial appraiser I could call one up and say, hey, what's the cap rate for a Class B apartment complex in a certain zip code? And he'd go, probably, 6 to 6.5. And then you have sort of what the market is paying for that kind of property. And so going back to that example of a $200,000 a year rental income with $100,000 a year in expenses, you have $100,000 of profit. And then if you know the cap rate, you can divide the $100,000 of profit by the cap rate, and that will pop up magically what the value of that building is.
That's a good. It is a business, right?
It is a business.
It doesn't matter anything else.
Yeah.
Just what's generated.
Doesn't matter if you hate the paint color. Doesn't matter if it's got a dead tree in the front yard. The profit it makes is what drives the value of commercial. And so there's a couple of things you can do about that, right? You can lower the expenses or increase the income or both. Yeah. And when you do those things, you drive the value up. So as an example, and it actually doesn't take very much change because it's, the profit is a pretty small line when you subtract all the expenses. So even $10,000, divide $10,000 by of rental income, more profit a year by 0.07, you're probably going to come up with a number, something like 120. Are you doing it? Tell me, what is it?
What is it?
Okay, $142,000. I guessed 120. I was off.
That was close. I mean, well, not close if you want to be specific.
But the point is, in commercial real estate, that $10,000 shift where I've either lowered expenses or raised income by $10,000 a year drives $142,000 worth of valuation back into that property.
That is a lot.
It's a lot. And the bank uses the same math. That same math is how the bank values it. So I was saying with single family, as they appreciate, I always like to scrape the money out and redeploy that capital.
Yeah, just don't let it sit.
That works as long as the market is appreciating. And single family generally does, but sometimes it doesn't, or sometimes not by very much. With commercial, you can actively, instead of passively waiting for the market to come up, you can actively do things to lower the expenses or raise the income, and that math is how you would come up with how much value you've created.
So it's up to you to determine the price at which you sell your property based on your numbers.
And you don't have to sell it. You can even refinance commercial, and they'll use the same math we just went through. So if you, Sebastian, were to buy a building and to improve its profitability by $10,000, we just saw that it's $142,000 in valuation increase, right? So if you did it by $100,000, it's $1.4 million in valuation increase.
That's a lot.
But it scales, and it's linear, and you could go back to your bank and say, hey, listen, I've driven the value of this property up. I'd like to refinance some of that value out and go buy it. So it's all about sort of keeping that capital moving forward, and it's tax-free as opposed to selling it. You pay taxes.
So from your perspective, I know that you say you keep moving that capital. When do you feel that a property is so good that it's not worth moving, that just
Yeah.
leaving that asset.
Honestly, all of them are that good. I mean, in a lot of ways, you should never sell a building, right?
Right.
The only thing, the asterisk on that is your own time. So, you are trading evenings and weekends to make all this happen. And obviously I'm sure there's people a lot better than me at like turning it over to a team and spending zero time. I'm not to that place yet on some of the buildings. I still have to, swing through once every couple months and just make sure everything's good and give people feedback on how it's looking. But, your time is the only reason you should sell something, in my opinion, and it'll change tomorrow. So don't write that in pen.
I'm about to say,
Right.
Are you about to say something controversial?
Well, no, I think this concept of refinancing it, because it's non-taxable, you don't have any sales commission losses, you don't have prep time to get the building ready. Like, I can just write an email right now and say, hey, I'd like to talk to you about refinancing the money out of this building, and I can do it non-taxably with no loss of value. So like when you pay a tax or when you pay a sales commission or when you pay a bunch of money to prep something for sale.
Right, turnover, it's so much, especially in commercial.
Yeah. All that money, that value is lost. Whereas if you refinance the money out, you can redeploy all of it with no parasitic loss.
Somewhere else.
Right.
And ideally, that business, that commercial property, it's already cash flowing enough to pay itself.
Right. Yeah.
That's an infinite loophole.
Yes, exactly.
Yeah.
So, but yeah, that forced appreciation concept on commercial is really appealing. So what I and many other people look for would be one that's maybe not well managed. So no one's moved the rents in years and they're well below market rent. Or maybe there's some, a lot of times these are a business, but they're, somebody bought a new pickup truck on there and they are buying new tools all the time.
They're not
and
running it like a business.
they're not running it efficiently. Yeah.
So you come in and you make the spread wider to
Yes.
profit more.
Yes. Yep. And so like that opportunity, like you can find a property that has a really excellent building and the structure is great, but it's just not been well managed. And so the rents are low or the expenses are high. And you can basically write a couple emails and say, hey, we're going to stop spending money on that. And hey, we're going to, I'm going to hire somebody to come in and do whatever, right? Something that increases the marketability so you can raise the rents. I mean, it can be as simple as adding a playground and some trees.
Yeah.
It can be as simple as just keeping the halls clean, right? Or writing a note to someone that jams their music all in the middle of the night to say, stop it.
Yeah.
And then you can start top grading your tenants and they'll pay a better rent for a better place to live.
Yeah. That's definitely true.
But some of that's not a huge amount of money. It's just somebody saying, hey, no more jamming music at 2 a.m.
And that goes back to time, right?
It all comes
Do
back
you
to
have to time to manage
time.
all that?
Time is the limiting factor, and work-life balance. Right, you got to work your regular job and do this. And if you have a great team with people that feel invested in the success of the building, it maybe isn't that much time for me. Like I have properties I haven't been to in 3 months. That someone else is there 3 times a week. So it's all running, and I believe it's in good shape. So I don't need to spend too much time there.
And you know that they're cash flowing just fine. Everything's fine. Tenants are happy.
Tenants are happy. Cash flow is great. The bills are paid, and the place is in good shape.
Now, knowing that we just have this commercial real estate talk, right? Why do you still own single families?
That's a great question. One strategy that lots of people employ would be to roll it up and, sell it and buy something else. In this case, they're not costing me any time. I've got great management that's doing it. And I literally have not, there's one I haven't been in 11 years.
Oh, wow.
It's got great tenants. My manager's on it. It's not costing me time. And I would have, if I were to sell it, I would have that parasitic loss of
Renting it, turning it over,
Yeah.
realtors, closing costs.
possible taxes, right? And so in that case, because what I'm really protecting more than anything is my time, it does not
refinance.
get a red flag. I just refinance and do it again. I guess that's the other thing, though, right? Because I've scraped all the equity out of these things, selling it isn't that motivating to me either, because I would have to pay back a bigger loan that's pretty close to the value. So to get $200, $300 in cash flow a month out of something versus maybe a big check for, not that big, I'll just let it ride.
That makes sense. I mean, still there's other ways that you can sell it with the mortgage, like a sub too, right?
Yep.
Something like that.
Oh, absolutely.
There's always ways around
There's always ways around it.
You just got to know the right people.
But that trips my time flag because I would have to go figure that out, right? And I'm trying to not. So I kind of see myself moving in fits and starts, right? Like where I learn something, I get really excited, I go do it, and then I just kind of have a resting period, right? Let's let that soak, let's figure it out, and then maybe I'll do something else that I get excited about. But it's never sort of a straight line of effort, right? Like I'll put in intense effort for 2 or 3 months on a project. I'm there every weekend, Saturday and Sunday, all day, figuring it out, and then documenting it and sharing it with someone else to say, here's what I've learned. This is how I think we need to fix this or address this problem. And then I'm kind of out, and I let them go.
Figure it out.
But so, like, the pace of when I start a new project would not be sustainable to do that all the time.
Right.
Because it's sort of intense for periods.
You can't manage your time like that, right?
Right. Yeah.
So let's bring it back to time. How do you find yourself managing the time now? What does that look like now that you're more? I don't think you're as active, right? You're more on the finding the deal because that's what you became good at. Now you're more on the passive side. How are you managing that? What does your time look like managing those things?
Yeah. You mean like how much time am I spending on that kind of activity?
We could say that.
Okay. I'm spending almost no time on the daily operation of anything.
Oh, good. So 10x your money.
Right.
Yeah.
But to your point, I am trying to study on. I'm spending most of my time, I would say, is on my couch with my phone in my hand, educating myself on what is the value of this, what is the what is the velocity of this market, right? If something hits the market, is it going to sell tomorrow? Is it going to be sitting there in 2 months? What is? So I'm just trying to educate myself. Is mostly what I spend my time on now. Now, when something trips a flag for me where I say, ooh, that's really interesting, then I'll send my buddy Darson an email and say, hey, you know anything about this thing? And if he says no or yes, here's what I know, whatever, I'll kind of do a little research. If I kind of go cold on it, I'll just let it lie and I'm done. But basically, the market will, I guess the way to say this is the market will determine when I pop back into action, right? Is when I say, oh, that's a deal, and I get trusted advisors like Darson or Jared or, whomever that say, yeah, that actually does look like a deal. Then I'm ready to dive in.
Yeah. So I was actually having a conversation yesterday with Jared about, he was explaining to me seller's equity finance, which was mind-blowing to me.
Yeah.
Are you familiar with this
Oh,
concept?
yeah.
I bet.
Yeah.
What do you think about it?
I've done it on both sides.
You have done it on both sides?
Yeah.
What are the advantages on the seller side and on the buyer side?
For the seller, I think it opens up a broader range of buyers, right? So somebody with maybe less down payment can come into the deal because, in essence, it's a second loan. It's a second mortgage that the seller is offering to the buyer. So, that's the simplest way to think of it. And so, for the seller, if you can suddenly lower the bar of how much cash someone has to bring to the table because you're going to offer to cover some of that gap, suddenly you've got a much broader group of buyers. So it offers flexibility and broadens your net a little bit.
I don't think we actually defined what seller's equity finance was. So could you summarize that for me?
Yeah, sure. So if I buy a building for $2 million or let's say $1 million, and over time it grows to $2 million in value because of the value add forced appreciation we've done.
You were due diligence.
Right. So now I've got $1 million in equity. And so I could sell that, and that building is now worth $2 million. I could sell that building for $2 million and tell somebody they have to come with cash and a mortgage. And the mortgage, the bank is going to say, well, they have to have at least 25% down. So in that case, they got to come with $500,000 in cash out of pocket in order to get 25% of $2 million. And then the bank will write the other 75%. And as the seller, you walk away with that money. When you're doing a carryback loan or an equity loan, basically as the seller, you're saying, well, I'll tell you what, I know you have to come with $500,000 to buy this building. I'll do $250,000 as a loan to you, and it's basically a second mortgage where the seller becomes a bank for the buyer. There's some risk to the seller. Obviously, that person that you've relinquished that property to now has less skin in the game because they've got the bank's money and your money and maybe some of theirs. So you got to believe that they're going to operate it well and pay it and all that. But it can help get somebody going and it can help a deal maybe drive a higher price because you've introduced some more flexibility and it becomes an asset of the building that, hey, I can get into it for less money. I can get into it maybe something bigger than I thought I could. And so it definitely offers some flexibility for the buyer. For the seller, it can be good because obviously the goal of this is to have money coming in passively. Doesn't get much more passive than that, right? As long as they pay.
Yeah.
So that's sort of, and as a seller, it's great because you can, just broaden your net. For a buyer, they can get into a bigger property.
What are your thoughts? Are you more of a seller finance, debt finance, seller finance, or more of a equity seller finance?
Maybe I don't know that. I'm thinking of equity seller finance as just a second mortgage. Is that kind of how you're thinking it too?
It's the way it was explained to me is that, well, let's say it's 1 million goes to 2 million, right? But then it's appraised at 2 million. Somebody's not gonna want to pay 2 million for it. So I'll tell you what, I'll give you a percentage of it. I'm still gonna be in the deal.
Oh, I see what you're saying. Okay.
Yeah.
Oh, that's different than what I was thinking you were asking.
Because that one's debt.
Yeah,
You're giving the other person a second mortgage.
So basically letting them buy in a share of the building.
Like fractional shares.
Got it. Okay.
What are your thoughts on on that one?
I think if
have you done it?
I have not done that. I've purchased some properties with partners, so it's kind of like pre-negotiated. We all went in together in that scenario, and I could totally see you doing it like after the fact. Like, okay, I own this building. I'm going to sell a share of it for whatever we can agree on. I think with any of them, whether it's seller financing or what you're talking about, where you sort of sell a percentage of the building to someone after the fact, it all comes down to the partners and the players, right? Like, is it good? Yes. Is it bad? Yes. It depends on the people and the agreement.
Partner's good.
Right.
Right.
Yeah. So yes, it's both bad and good.
Bad and good.
Right.
All right. Just to wrap it up, give me 3 helpful tips that you've learned throughout all of these years investing that you think are mistakes that you could have easily avoided.
That's a great question.
Don't mean to put you in the
3
spot.
again,
If you
geez.
got 2.
Yeah, there's always
1 or 2 is fine too.
I think and I don't want to be cliche, but because there's stuff that everybody says that is probably right. I think the first one is just start. You will make mistakes. Even if you do everything right and you make all the right decisions, stuff's going to happen. So I think just start would be my first thing is, you almost never regret what you do. You regret what you didn't do. And so, I would say begin.
Do more than you talk.
Yeah.
Okay.
Right.
I'm not following that advice.
I'm not either some days. So that would be one. You're rarely going to get punished in life, by trying to do something better, or different than everyone else. Like most success comes out of being a little different, being a little more brave, and taking a little more action. Like those are all good things that almost never people almost never get punished for, right? Unless your do more is like robbing banks, then that's probably not a good
That's
idea.
probably not a good idea.
But yeah, just take action. I guess the other one that comes to mind a lot when I talk to people about what I'm doing as far as investing, I'm making almost no cash every year. And everyone's first thing is, well, how much cash will I make? Right? Whenever they're thinking about investing, right? Like I go to work, I clock in, I clock out, I get a paycheck, right? It's a very linear, controlled environment, and it's all very short time frame.
Yeah.
Investing is long time frame, long thinking. And so there's multiple ways to make money in real estate, right? There's tax savings. There's offsetting of costs, right? Like if your cell phone becomes a business cost, you were going to have a cell phone either way. So now you've benefited, from tax savings. There's depreciation. There's all kinds of great tax benefits, especially for real estate. Like I tell my wife all the time, I get paid once a year, right after we get our taxes done, is my payday for real estate. I make almost no cash. I make no cash in real estate today. When I retire, that'll change. But right now I'm trying to invest in properties so that
Long-term vision.
long term, I don't need any money right now, so I'm not taking any out. We're not doing big vacations. I've been wanting a Corvette for 20 years. I still haven't bought one, right? But that's a choice.
But you have snowmobile.
I do have a snowmobile,
So,
but I
catch
bought
the
it
racket.
used.
You bought it used? Okay.
I've never bought a new car in my life.
But snowmobile.
Always used, yes. So, like, the initial thought that people have is, how much cash will I make? And when you say none, if you do it right, they're like, well, why the hell would I do it? And what they don't realize is appreciation, depreciation on taxes. Like, there's all kinds of other things where you're going to make money. And it's not about the cash initially. It's about building the wealth and the ability to produce cash in the future without active participation. And so just understanding all the different ways, like if you can be patient and wait for the outcome, and it's not going to be cash immediately, probably. Like you could totally manage it differently than me and make it have cash right away. I could make anything that I have right now make cash. But I'm saving the money to buy something else, or I'm investing the money back in what I have now to make it so it will have more value in the future. So it's not a cash game. Obviously, it is a cash game. What I'm doing with that cash is leave it in the system. I'm not taking any for myself.
There will be a time.
There will be a time when I will absolutely be taking cash out of this ecosystem that I've built.
There's a time for everything.
There's a time.
Okay, I'll keep that in mind.
Yeah.
That's good. Yeah, because a lot of people are just like, okay, how much am I going to make on that flip?
Right.
So, but this is good education. I think this will wrap it up. Thank you so much for coming here.
You said 3. I have one more for you.
You have one more? Yes. I didn't want to put you in the spot. I said 5. You said you got 3.
I got 2 more of that too. We'll talk later. Stay within your scope, right? Like, I'm not a construction guy. I can do construction. That's not the highest and best use of my time, right? Like, there's people that are better at it that are cheaper per hour than I am like the things I forego are worth more than the things I'm saving money to do my own construction. I would not be a good flipper, right? I'm good at communication. So like value add where needs to be managed up for an apartment building is something I'm really good at. And I can build a template that other people can send out and manage the process. So like stay in your
lane.
Skill sets.
Sort of thing.
Yes. So take your time to find opportunities where they mesh well with what you think you can do well at, and everybody has those skills that could be used. But like for me to be buying places that need new roofs, I'm not a roofer. right? So like somebody is out there in the marketplace, a very good roofer, and that's the perfect house for them, or the perfect investment. So I would just say stay in your, not that you can't grow that, not that you can't expand that over time, but especially initially, stay with what skills you can uniquely bring to a project.
That makes sense. That makes sense. Yeah, because I see a lot of people going into, like, they're so good at construction and they're thinking they're going to go in syndication.
Right.
What the hell would you go in syndication for?
Right.
You don't know anything about it.
You don't know anything about it.
Yeah.
Yeah. You can learn it. You can find a partner that can do it with you.
But that's not where the biggest opportunity for you to make money is.
Right.
Yeah.
And we've talked about how you have to be ready to jump when, you have to have the information and the sort of steps in place to jump when it's time to jump on some of these things. If you're going to jump on something and you don't have a person that's got experience on syndication, either you're going to miss the deal anyway, or you're going to get yourself in over your head. So so stay in your lanes, and you can change lanes, but you got to signal and know what you're doing, right? Yeah. So just be thoughtful of what you are bringing to the table uniquely, and I feel like everybody can figure out something that's a good fit for what they're trying to do and what their skills are.
That was good.
Cool.
That was really good.
Awesome.
Really appreciate you coming here, man.
Pleasure, Sebastian.
That's a lot of information.
Thanks,
I know that a lot of people are going to find it useful because they just can't take the first step. They're afraid. And coming from a person that already has the experience is not the same coming from me, somebody who's just getting started, you know what I mean? Mm-hmm. So it's important that we listen to the people that are far ahead of us in this journey and learn from them.
I feel the same way. I've got a lot to learn, and that's the fun thing about this, right? You can sort of learn a new neighborhood, you can learn a new building type, you can learn all kinds of new strategies. It's a really fun
learning
adventure.
Never stops.
That's right.
All right, guys. Thank you so much if you made it this far, I'll make the call of action. If you find this content helpful, creative, it will really help us if you subscribe and hit the like the button. We release content daily, and we really appreciate your support. You're going to learn a lot of this, especially if you're located in the Midwest. But that's all I got for you. Next week, we're going to have another special guest that's going to bring in more information, more mind-blowing facts. And I would just suggest you stay tuned. And thank you for watching. Have a good day.